Hey guys, as promised, I'm going to do a podcast on why the Fed needs to raise rates now. We did do a blog, we wrote a blog about it, but also want to do a podcast, see if people can find it and maybe talk about it and see what happens. So why we're saying the Fed needs to raise rates and start raising rates right now. So the United States and the Federal Reserve, in our opinion, needs to lead the world and start raising rates now. I'm sure you've heard many analysts and talking heads say the Fed cannot raise rates because of our $19 trillion in debt, that it would be much, much too expensive. Nothing can be further from the truth. Well over 60% of our national debt of $19 trillion and our total debt of $100 trillion, which includes states, municipalities, counties, is financed between 3 and 4.5% interest rates, not the current 1.5% rate. So there's plenty of room for the Fed to start to normalizing rates. When the financial crisis hit, then Fed Chairman Ben Bernanke had a theory that quantitative easing and zero-bound rates would increase asset prices, which in turn would trickle down to the economy, creating jobs and inflation. Well, 8 years later, QE, quantitative easing, and zero-bound rates have proven Mr. Bernanke's theory incorrect. One part of his theory was correct, however, and that was increasing of asset prices as the stock market is at all-time highs. There's no fundamental reason for stocks to be where they are. Current prices do not reflect corporate sales and earnings. In fact, the majority of the stock market move since the financial crisis is directly related to QE and zero-bound rates. The problem which the Fed has created goes deep. It's now impacting pension funds in a very negative way. Many, if not all, pension funds have a business model which dictates an average annual return of 6 to 7%. And with the yields down around 1.5%, the math just doesn't add up. Take the Central States Pension Fund, for example, one of the largest in America, which is part of the Teamsters Union. They currently take in $1 for every $3.64 which they pay out to retirees. The current yields are so low they cannot make up that $2.64 difference. The lead manager of the pension fund sent a letter to the Treasury Department and filed paperwork to cut benefits by more than half, saying if they do not cut benefits, the fund will be insolvent in less than 10 years. Jack Lew of the Treasury Department refused their proposal of cutting benefits, so now the lead manager is lobbying Congress for a bailout, and we all know that where that money would come from, the taxpayers. This is just one example from the many pension funds that are in trouble. Why has QE and zero-bound rates not created jobs and inflation? It's very simple. There's no incentive for investors to buy bonds. Now, one can argue that treasuries are up near all-time highs, so there's obviously demand, and that's true to a point. The U.S. Treasury market is a safe haven. It's always been considered a safe haven. And with over $13 trillion in negative yielding paper around the world, it's attracting many big investors as far as foreign countries. On top of that, in 2016, the Fed will buy approximately 50% of every new 10-year Treasury issued. So the demand from investors is certainly not as strong as it is at first glance. Additionally, with muni bond yields 2 to 3.5%, there's no incentive from the investor to lock up their money with such a low yield. Therefore, states and municipalities can't raise the money for projects like new schools, school additions, roads, bridges, tunnels, other type buildings, etc. If they cannot raise the capital for new project, that leaves many people out of work. And we're going to talk a little bit more on that in a bit. We all know that the stated unemployment of 5% is completely inaccurate. With 94 million people not in the workforce and a labor force participation rate at 1977 levels, it's statistically impossible for the unemployment rate to be 5%. How does the government get away with telling us it's 5%? They simply stop counting those who no longer receive unemployment benefits and assume those people are no longer looking for work. I'm sorry, but this is a terrible way of calculating unemployment. The government is assuming millions of people do not have to work and can simply retire. They're assuming millions of 20, 30, 40, 50-year-old men and women have the means to retire. It's absolutely absurd. So why do we say the Fed needs to start raising rates now? Contrary to popular belief, by raising rates off of zero-bound levels, it will create jobs as well as inflation. Normally, lower rates create inflation and will create jobs, but not when it's too low. That's the problem. Let's go back to where we were discussing muni bonds. When bonds normalize and munis start yielding 5.5% to 7%, it gives an incentive to the investors. They will begin buying muni bonds again, back to the levels of years ago. And guess what? Municipalities will then have an abundance of cash flow, which will lead to those states, counties, and towns to start doing projects again. They will start building schools, putting additions on schools, roads, bridges, tunnels, buildings, etc., hiring people, all of which will employ millions and millions of people. Everyone from architects to steel workers to masons to electricians to plumbers to construction workers to accountants to lawyers, they'll all be put back to work. Many of these workers who are currently unemployed will start buying things, hiring services, etc., which will all lead to a growing economy and inflation, which the Fed desperately wants to see. So, what will the short-term pain be for the long-term gain? There will be a short-term gain for Will there be a short-term pain for long-term gain? Absolutely. Will stock markets sell off 20, 30, 40% or more? No doubt. Will bonds go down? Of course they're going to go down because the Fed will be raising rates. Will the dollar rise? Absolutely, which actually may be a good thing. But in the long run, the nation will be better off. Millions of people will be put back to work. The government will have more tax revenue coming in. Financial markets will go back to valuing companies based on fundamentals. Again, sales, revenue, earnings, and not QE and zero-bound rates. Stock markets will recover as businesses start to grow sales and earnings from the millions of newly employed workers spending once again. Now, I know Janet Yellen and the Fed understand this scenario. So why have they been so reluctant to raise rates? Other than there's no economic reason to raise rates according to the economic reports that have been coming out over the last few years, I'm really not sure. It could be that they don't want to admit QE and zero-bound rates didn't work as intended. It could be that they're afraid of losing credibility, but most likely they're afraid of taking the short-term pain. Bottom line is the Fed needs to swallow a pill and take that short-term pain head on and raise rates now. They need a slow and steady rise in rates to normal levels. The longer they continue to play this QE and zero-bound rate game, the deeper the problems will become. That sums it up in a nutshell why the Fed needs to start raising rates now, even though there's no economic data to back raising rates as there would be. It's just the fact that that extremely low interest rates are not doing what the theory thought was going to happen. It's actually creating a very, very dangerous problem. So hopefully you agree with that, and if you do, hopefully you share this podcast or you go to our blog and share the blog. Maybe we could gain some traction amongst people. Maybe we could gain some traction amongst politicians and go from there, because we're headed down a very, very bad path. That I can assure you. So that's it. Have a great rest of your day. If you listen to this, hopefully you enjoyed it. And we'll be back with another podcast in the future. Thank you.